My name is Tyroka Battle, and I'm a Metro Detroit agent in the mission. It's getting crazy now. All right, last one.
Does it sound a lot better? I think it does sound a lot better, actually.
All right. For those of you who are new to the channel, my name is Tyroka Battle. I'm a local real estate agent in the Metro Detroit market in Michigan, and on this channel we discuss all things real estate. My goal is to try to explain all the knowledge that I've learned over the years so that the experience for buy, selling, and investing is a lot easier for you. So, if you find this video helpful, please like, comment, subscribe, share, and please leave feedback below in the comment section, as I'm always looking for new topics to talk about. In today's video, we will be learning about FHA and conventional loans. Now, if you're anything like me, you want to understand the process well before you even get yourself into it. And I think that's one of the most important things you can do when it comes to buying a house. So let's jump straight into the overview of what FHA and conventional loans are, as these are the two most common loans used in a traditional transaction for an average home buyer. VA and USDA loans are also loans that are traditionally used in mortgages, but we'll cover that in another video. FHA loans, or Federal Housing Administration loans, are government-backed loans used to help first-time home buyers with lower credit scores or smaller down payments qualify for purchasing a house. You don't have to be a first-time home buyer to use this loan option. As long as you have not owned a home within the past 3 years, you should be okay to qualify for an FHA loan. But I would still personally check in with your local lender, as some qualifications vary from state to state. FHA loans are approved by only FHA approved lenders, and these lenders can come from your local bank, a local mortgage company, or a local credit union. And you can use this loan to purchase or refinance single-family dwellings, condos, manufactured homes, and 2 to 4 unit apartment buildings, which is considered house hacking. You could also use this loan for new construction, but that will also vary from builder to builder. On the other hand, you have conventional loans, and these loans are not government-backed loans, and they're also issued through credit unions, your local bank, local brick and mortar mortgage companies, and other private lenders that issue mortgages. Many of you may read that and think like, there's absolutely no way that I can get approved for that loan. But honestly, it's not the case. And in fact, many people get approved for this loan, and it really does fit people that are looking for homes that are, fixer-uppers, or people that have better credit, which I'll go through later on in the video. But it's not hard to achieve this loan. In addition to that, this loan is likely going to be used for first-time homeowners, second-time homeowners, and investors who are looking to invest, because you can't use FHA unless you're house hacking to invest into something. One of the most significant differences between an FHA and conventional loan is definitely going to be the down payment. With an FHA loan, you can often expect the average home buyer to put down at least 3.5% of the purchase price. And this is what makes it most feasible for the first-time home buyer because of the low down payment that it offers. To give you an example of a property, let's say you like a house that's $100,000. The down payment for that property is going to be $3,500. But you got to understand that that is not your total down payment for that house. You also got to include closing costs, which, quick tip, make sure when you see a house that you like that you contact your lender and have them give you a breakdown of both your monthly payment and cash to close, because your cash to close is going to include your closing costs for that property, which is going to be appraisal, taxes and insurance, etc. That's going to tell you exactly what you're going to be bringing to the closing table. And that's normally 2 to 3% additional to the purchase price, but that also varies state to state too as well. For conventional loans, they typically offer a higher down payment than 3.5%. Usually those loans are between 5 and 20% of the purchase price. However, I have seen lenders issue in past transactions pre-approval letters with 3% down. So there is a possibility that you could get 3% down conventional as well too for first-time home buyers. But for the average person, I would expect and plan for at least 5 to 20% of the purchase price. Your credit score and financial history are going to be a big determination on how much you're going to be required to put down on a conventional loan as well. Now let's talk credit requirements. FHA loans are pretty lenient when it comes to credit history and income history. So as long as you have a 580 credit score, you can qualify for an FHA loan. I emphasize 3.5% down because some lenders offer pre-approval letters for buyers anywhere as low as 500 to 579. But that down payment will require probably 10% down, and you'll likely have to go through some pretty strict income requirements in order to get approved for that loan. And as always, remember, down payment does not include closing costs, so always check with your lender the loan estimate. Conventional loans are generally going to require a higher credit score, anywhere often between 620 or higher. In my experience, you generally start seeing the top tier pricing for interest rates anywhere between 700 and higher. Mortgage insurance is another key difference between FHA and conventional loans. The best way to describe mortgage insurance, it is insurance that is lowering the risk for the lender who is issuing a loan out to you that you would have not have qualified for, so that you can qualify for that loan. The bank is going to always require mortgage insurance for buyers who are putting less than 20% down. So let's go over the differences in that. For FHA loans, they will always have mortgage insurance that's built into the life of the loan, and you can expect to have an upfront mortgage premium that's paid and an annual mortgage premium that's paid. Mortgage insurance can increase the monthly payment on your loan, which, quick tip, monthly payment on the mortgage consists of your principal, interest, taxes, and insurance. It's normal to see insurance waived once 20% down is achieved on a conventional loan, but with FHA, that's not the case. However, if you used FHA and you put 10% down, on the 11th year, you can expect that insurance premium to be removed. Simply put, the best way to remove PMI on your home is to simply refinance FHA to conventional, but that can only be achieved once you have reached 20% equity in your house. In all honesty, just reconnect with the lender and realtor that you bought the house with. Talking with the lender is going to help you understand where you are in terms of the life of the loan, which is going to help you understand your equity. And talking to the realtor is going to help you understand the value of your house in the current market, because value changes over the years. Now, like I was saying before, if you're putting less than 20% down, you're going to require mortgage insurance, and that also is the case for conventional mortgages too. One thing to also note too is that in comparison to FHA, if you've got a conventional loan and a credit score higher than 720, you can expect that PMI to be less expensive than an FHA PMI. When it comes to loan limits, there's always going to be a limitation on how much you can buy for each loan. With FHA, the loan limits are very generous, so people who are looking in a more expensive housing market may tend to go FHA over conventional just because of the pricing and what it has to offer. In the Michigan market, the loan limits for a single-family dwelling FHA is up to $472,000, and as for multifamily dwellings, I left that below under the screen for you guys to check out. As for conventional loans, the loan limit is up to at least $726,000 for single-family dwellings. You should check out the below screen for the multifamily dwellings as well, as those are much higher than FHA limits as well too. The best thing to do when it comes to knowing your loan limitations is to just consult your local lender, as they're going to always have the best understanding of your local market's limitations, because honestly, these limits change from state to state, county to county, city to city sometimes too. And if you're interested in knowing the limitations in your local market, check out the link below, because it's going to have the limitations for both your state and county. Now let's talk about the pros and cons of each loan, because I'm pretty sure you've been waiting for this whole entire video to get to this part, unless you skipped. Before I say anything, let's make this clear that there truly are no disadvantages to each loan. Just because you get approved for an FHA loan does not mean that you're going to get the worst pricing or the worst house out there. And the same goes for the conventional. You know, it's all going to be based on your own personal finances, your own personal credit history, your own personal time frame, debt to income ratio. There's a lot of things that are taken into consideration, and the approval that you get approved for is always going to be based on what's best for you. And sometimes you get approved for both. So it just happens like that sometimes, but there's no true disadvantage. I just want to make that clear. So like we talked about in the beginning, with FHA, one of the main advantages is going to be that low qualification requirement. The 580 credit score, the low down payment, those are really going to be the two biggest things that make FHA most beneficial for people. And like I was also saying earlier, sometimes you can get qualified for as low as $500 to $579 for that. That's why an FHA loan is good. It allows low income and low credit buyers to get into the market to purchase their first home. Another pro that we didn't really cover earlier in the video is the debt to income ratio for FHA. The best way to describe what debt to income ratio is that it's your monthly debts in comparison to your pre-tax income monthly. So the monthly debts that you pay for are going to be like your school payments, car payments, personal loans. If you took that IKEA loan out for that new couch that you wanted, all those things in relation to your income. With FHA, you're also going to be protected through stricter guidelines, and you're going to see that come into play through the appraisal process, where the appraiser comes out to assess both the value of the house and the condition of the property. So for example, when you are looking at a property, FHA requires properties to have houses that don't have chick paint, no cracked driveways, handrails on staircases, handrails on decks, handrails on basically anything with more than 3 steps, carbon monoxide detectors, smoke detectors. These are all going to be things that are required in order for you to purchase an FHA home And in most cases, if they're not there, the seller is responsible for making those repairs for you. But that's also something that can be negotiated throughout the process. On the flip side, the disadvantages to an FHA loan are going to be the stricter guidelines for each home, as well as the private mortgage insurance for the house. So, for example, you're not going to be able to buy that fixer-upper that may need a little bit of love, something that's going to require some structural modifications prior to moving in. Things of those natures are going to be probably something that can be covered through a conventional loan. You might be able to buy like Granny's house, which is like 5 out of 10, standard carpet, paint. And as for conventional loans, the biggest advantage to these loans is going to be the control over the structure of the life of your loan, as well as the appraisals being more forgiving. 30 years is the most common loan structure for conventional and FHA loans, but sometimes you have the ability to go to a 15 and 20-year loan. Now, this could be good for someone who is looking to pay off their loan sooner, but this does mean that the monthly payment for that loan is going to be a lot higher. So consider your plan of attack when choosing what loan structure is best for you if you're going a conventional loan. In addition to loan structures, like I said, appraisers are going to be more forgiving on the property, meaning they're going to care more about the current market value than its current condition, which means that with a conventional loan, you'll be able to get that fixer-upper and potentially tap into some of that equity depending on how you buy it. If I had to choose a main disadvantage for a conventional loan, I would probably go with the debt-to-income ratio and credit score. And that's just for first-time home buyers. Like we talked about earlier in the video, 620 or higher is what you're going to need to get qualified for a conventional loan. And as for the debt-to-income ratio, 36% or less is where you're going to need to be at in order to qualify for that. I have seen lenders qualify people conventional with much higher DTI and a little bit lower of a credit score. So it's always important to check with your lender on the qualifications for that. So, which loan is best fit for you? Honestly, that's just going to come down to your personal credit, income, and financial situation. As always, they're going to look at your income history, credit history, how much you have to put down, as well as debt-to-income ratio, and what city you're looking in. All these things are going to be taken into consideration when you're qualifying for a loan.